All right, and we're back. So, I guess the big question is, did I blow up my account last week since the last video? And the short answer is no, of course. But I wanted to go over what I've changed, how I've made some adjustments, and where we're sitting at currently versus where we were just a couple days ago. Because obviously we had a pretty huge rally in the S&P, obviously in the markets in general, up a couple percent. I think it was still down for the week. You can see that technically it's still down on the year. I think even down further than it was. Let's see where Nasdaq is. If it'll cooperate. So yeah, Nasdaq's down almost 6%, and we're definitely doing better than that. And obviously, if you don't know who I am, I'm Ben Collins. I'm the Chief Investment Officer and founder of Options Autopilot, which is an automated options platform. You can get info below if you want to check that out. And that's basically what's been successful for me this year. If we go to Options Autopilot dashboard, anyone who's been following along, and if you haven't, definitely subscribe, because I am showing my wins and my losses, and things that are going well and not. We're obviously doing much better than even we were before the drawdown, but as I mentioned before, annoyingly, I'm not up this much because even though the automations are successful, this is just from the automations. If we go into Tasty Trade, we have Tasty Trade and Schwab currently, and technically TradeStation, but we're still working on that a little bit, integration. But we can see that I am actually, so I'll need to get used to the Tasty Trade setup. So we're up 3,600. Before we were up 3,000. So we are up even more than before, which is good. So we've recovered more than we lost. But then I still took that loss on the ARK short put spread. So annoyingly, I'd be up even another $1,130 had I not taken that. But you win some, you lose some. That's why we manage risk. And that's why you should, always have a trading plan. And that was mine, and I followed it. I did not do that on automation. Like I said, the manual ones haven't been as great. But one of the interesting developments is Intel. I talked about how I basically, bought some long dated calls on Intel, and then it was reversing course. I had made some money initially, and then had switched out to some longer calls. And then if you guys are following the market at all, they came out with some news that they're getting a new CEO on Thursday. So my rule on buying long and like directional positions now is I won't add to a position unless it's profitable. So if anyone's kind of struggling at the moment, I go over this in the course. It's also below. That's 100% free. You just have to request access to Options Autopilot, and you can see it's on the site right here. But basically, one of the rules is that I won't add to a position, like a long position, unless I'm actually up on it. So I used to, back in the day, put on a position, and if it was down like 50%, I might double it. It would still be within my parameters, but it rarely ever worked out in my opinion. So a couple years ago, I had started to change to only adding to positions, kind of like progressive betting, if you're familiar with that. So I basically was down, can't remember how much, $600 or whatever, on on Intel. So I was just sitting here, and then obviously I did that video on Wednesday. It was down here. Then they announced that new CEO change. It popped up. I still think maybe I'm a little premature in adding to the position, but it was up at one point. So I did decide to add because I thought maybe it was going to be one of those gap and like goes, because it was one of those things where it's a pretty big shift, and people had run it all the way up to 27 previously. Yeah, over 27. So I was thinking maybe it'll at least come back up and touch here once it had gapped up. So I basically added, I'm not going to add any more. I'm currently still underwater on that second. Well, I guess I'm underwater on the whole thing, but in general, I'm almost back to break even because I had a profitable trade on it previously. So, year to date, I'm only down $128. Not the end of the world. But now I have 10 contracts. I had 5. You can see that I did that on Thursday, 13th, when they announced that. So we'll see what happens there. That's kind of a longer term directional position. We'll see how it goes. I haven't dug into it too much on a fundamental basis, but I've heard some obviously smart analysts talking about how their foundry is causing the issue, and if they kind of cut costs there or maybe sold it off, it would potentially be a $50 to $60 stock again. So I don't know what'll happen. I just also think that with that new CEO, my hope is that the news stream is more positive, which is usually what will drive prices because new plans come out, stuff like that. So I'm long the 35 strike, which is pretty far away, but if we go and look at where I'm at, so March 20th, 2026, almost a year away. 32 delta. It's kind of my typical, long dated position, right? If you're unfamiliar, again, I cover this in the course. Delta around 25 to 30 has higher gamma, so you're getting more benefit as it starts to move in your favor. You're gaining more deltas quickly, but that was kind of the thesis. That's why I added there. I didn't do anything on ARK. It's for the most part, not that you should probably go back and look, but it's always good to learn from maybe your mistakes if you can. It's mostly sat around. Obviously, I kind of got out around this point, but I would have probably gained back some loss. But I'm fine with why I made the change, why I cut the loss. That was all part of the plan. Another adjustment I did is close down one of my ES 111s. I was about $300 from the profit target, but like I had mentioned in the previous video, I was over allocated to a point where it was not necessarily a good idea from a risk management standpoint. So it was good for me to take that off and just gain a little more buying power back in the event that things turned over or whatever ends up happening over the weekend here. So I reduced that, and I still have 2 of my ES positions on, and I'll go over my MES too, but here's one of them. So we've still got that. I'm still feeling pretty good about those based on where we're at. Same thing with this one. So you can see, had I not closed it out until the end of the day on Friday, I actually probably would have been pretty close to my profit target on that one. But I chose to close that one because I was the closest. So my efficiency of my return on the risk was higher to leave these other ones open. So I could only have gained another $300 on whatever the required buying power was, versus the other ones I still had $400, $500 to my profit targets. So again, better use of my capital, I would say. That's just was my thought process, just for anyone who was wondering why I did that. That's kind of how I approached it. I actually thought about closing down MES. And again, to give you context, this is just a hedge right now. This was just a long put spread that I left on. Again, we have this option in Options Autopilot. And this was in the money too, right? It was fully in the money. And I thought about taking it off because I thought we might get a little bit of reversal and rally. But I was no, I'll just let it go and see how it plays out, because it still hasn't fully expanded to where it could. And I have always wanted to see where some of these will go. Same thing with why I left the rest of these positions on. I thought about closing down some of these other ones that I'm actually up a decent amount in terms of profit. And it basically, one of the interesting things about the 111s and why I kind of like them is I almost view it as, when you're up money, it's actually an even better potential for the market to drop, and then you can finish in that bear trap area of the 111. And again, if you're not familiar with the 111, it's covered in the course. I do have another, I think, video on it on my YouTube channel as well, and I will post some other ones on it as well. But that's one of the reasons I think it's kind of nice and kind of flexible. So it's almost like you don't feel a rush to take a profit there, because technically you can actually make more money if the market starts to sell off and you have, a decent profit already. So I ended up canceling that order because I wasn't getting filled, and I was like, I'm not going to chase this. I don't need to. I'm just going to leave it on. So these are in the money, right? And this was also in the money at one point. So as long as it doesn't totally fall apart, it could be interesting to see. These could expand and make even more money. So I'm really curious to see how that plays out, because I don't think we're out of the woods, and I'll go over that in a little bit in terms of the market. I added on a 30-year bond futures position. It was a 111. You can see I'm down on it at the moment. And technically, so this is just based on the contract. I'm not down overall. If we watch this, or if we look at this, I wish they would combine these a little better, but you can see like I'm up overall on the bond trades, 111s. So they've been working, and I think it's a decent spot for putting one on. I have a feeling, the market doesn't like uncertainty, and I think that we might, this is always hard, right? It's hard to know where exactly we want to use this line, but I kind of think this is still intact, but you could make the argument maybe it did break this new uptrend, but I still think it's not going to totally fall apart. I don't think that inflation's going to be crazy. There's all the talk about tariffs and whatnot, but I just don't. I think it's negotiating. Who knows? It could cause the market to sell off. I think actually the more important thing is going to be debt that's coming due, and how they try and manage that, and then of course the shutdown. So we'll see what happens, and I believe if those things if the shutdown starts to get talked about, and maybe the politicians don't agree, which they never seem to do. You can never rely on politicians to do what they need to do, unfortunately, regardless. So that could cause a flight to safety. So that's why I kind of want to do the 111, and it should be less correlated with the S&P 500, which is my largest exposure at this point. I didn't add to gold. I probably should have. I mean, I previously was talking about how it seemed like it was toppy, and then it ended up ripping the past few days. So that's just another reason to just leave the automations on. I didn't have it put one on because I actually was close to my limit on things. So that was one of the reasons I wanted to turn down my allocation on ES and free up more capital to do other asset classes, as I've talked about previously. So ultimately, we'll see where this plays out. This could continue. The path of least resistance, they'll say, is up. So it could continue. It was interesting that it went to the new high and then pulled back. I'm curious if it'll pull back again, but you just never know. I'll put one back on, and we'll just see. I think I'm down on it. No, I am up on it year to date. So let's see here. What else did we do? SOFI just kind of started to go in our favor a little bit. It wasn't anything like I didn't necessarily do anything differently. Unfortunately, I wanted to actually sell more puts, 10 strike puts, but didn't have capital available, and I also didn't think it was probably a good idea because I was, you know what I mean? You're already kind of leaning long with some of these things. So it did bounce a little bit. It's not like it's fully rebounding, so it doesn't give me a ton of confidence, but at least it's closer to this kind of long-term level, and my hope is have a risk reversal on there, that it'll continue, right? So I've pretty far out of the money at this point, calls, but I'm fine owning SOFI at $10 if it for some reason finished there in a year, but you never know. Things can change. Things can definitely change in that time frame. So we'll see. Make sure you stay tuned on that. Another, I think, Bitcoin put spread went on. Automation just ran. So that was the other one that went on. It did two. I just did the put spread. This is obviously just on the ETF. Seems like it's kind of recovering a little bit, or at least stabilizing. And so, again, it doesn't really matter what my opinion is. It definitely is. This is a top, and I don't know. I still think the trend is down. It's definitely in a down trend. But ultimately, just having the automation on, it's going to be selling these under the market, and that's the whole point of having it just run, because theoretically those should be overpriced over time. Just like most options, they're going to be, I think, 85% of the time they're overpriced. My XRP, which again, just kind of a whatever long-term hold, just for shits and giggles, just to see what happens there. It's recovered a little bit, so it's not hurting as much, and that's what kind of is contributing to the recovery. And I guess overall, we're definitely, so annoying that I always have to go back into year to date, but whatever. Before, I think we were, P&L was up 2,500 with fees. Now we're up 3,000. Again, had I not done that ARK one, it'd be 4,000. So that's annoying, but it is what it is. We're still early in the year. I think that this is giving kind of a good idea on how things can go and hopefully should go, because we're selling volatility on multiple different asset classes, and it's just doing it automatically. I did manage a couple things manually just because volatility was a little bit higher, and I wanted to trim down my exposure so other stuff could run. Because once it hits these allocation limits, then it just kind of it's not going to put any more on from a risk management perspective on Options Autopilot, which is good. It's correct. It's just more of I needed to go in there and kind of cut things down. Like I could cut down MES because I already have exposure through ES, but like I said, I want to see how that plays out. And what's interesting, and we'll add some of these things to Options Autopilot, because right now we will have the volatility based risk management, but I also want to add in like a tactical kind of volatility selling, because what's been interesting is I've been trading MES, which has gotten very illiquid more recently, but what's nice about it is it's smaller. It's the micro versus the mini, and so it's like your drawdowns aren't as bad when you get the volatility spike. And usually as volatility would spike over 20, 25, whatever it is, I would end up switching to ES and selling, because then I can earn more money, right? There's more risk, but I'm obviously earning more return from a dollar perspective. So that's actually worked out well. And if we look at, see where we finished. I very rarely, I guess just as a side, which I cover in the course, but I very rarely look at many indicators. I do follow the McClellan oscillator. It's just kind of a broad gauge of overbought, oversold, and we can see where it got to. And I was actually surprised it didn't go lower, and I maybe commented on this before, but someone that I follow was making an interesting observation that technically it's probably not going to get to these extreme levels right now anymore, because a lot of the sell-off is coming from Mag 7 and the large cap tech. But a lot of underlying companies are actually doing better than that, which people were talking about this for a while in terms of switching to equal weighted S&P 500. But if we go to, I wonder if we look at the value, value stays out of favor very long, and then comes into favor during these times sometimes, not always. But if we kind of look at this comparison just right now, value is actually up year to date 1.3%, right? When the rest of the market's down 3.6 to 6%, versus if we look at the growth. This is where I like Thinkorswim because you can technically compare them one to another. But if you look at growth, I haven't checked this beforehand. So there we go. You can see that the delta between them is massive. It's 9% effectively. So imagine you had switched into value instead of growth. You would actually be doing pretty well this year, at least not as bad. So not as well as if you were using Options Autopilot, but not to toot my own horn there. There's no guarantees that would be your experience depending on the strategies you're using. And that's one of the things I would say. We have people who are have smaller amounts, which is fine, and are asking questions on, well, can I use 2,000 or whatever capital? And yes, you can. You're just a little more limited. You'd probably have to use the ETFs, not the futures, instead. So like if you basically came in here and we're creating an automation. My apartment's Wi-Fi, so it's very slow. If you're coming in here creating an automation, you could do all this stuff with the ETFs. But basically what you would want to do is select the actual equivalent ETFs, right? And this is where you're getting the diversification. So I would recommend, we do have a plan where it's like a couple different strategy, like you can do 2 automations basically up to $20,000, but that is a little bit limited. I mean, ideally, you would have enough capital where you could kind of do what I am doing and get the diversification. Not totally, necessary, but that would be my recommendation, just because it's like anything, diversification is the only free lunch in town, as they will say. And having less correlated asset classes is kind of how you diversify your risk, right? And we can kind of see that from my results and just the results in general across doing it across those asset classes. So that's what I'm doing. That's my plan. I'm kind of sticking with that. I'm just going to let them run. I'm going to be heading out of town to Vegas next week. We're just going to let Autopilot go, and we'll see. Check back in and definitely subscribe and see what the results are. So I'll be curious to see what happens. Like I said, I don't think politicians are going to get together and agree when they should, and that could add some more volatility. Oh yeah, I guess I'll go over this real quick. I don't think we're out of the woods yet in general. I think that if we look at this, and my kind of play here is, this is now fully broken. This is a top, in my opinion. I talked about that, as it was happening, basically. Again, you don't know until it happens and confirms, but I think it's confirmed. I think that until we know otherwise, right? Maybe this will rip up higher and hit new highs. I don't know. But until further notice, I would say we're now in a downtrend. So I would act accordingly. It still makes sense to put on positions, but you got to be cautious. Do it in small amounts and leg in. That's how I'm doing it, because again, the benefit of having the automation on is just that it's putting these positions on, and as the market's falling, it's putting on below the market. It might get stopped out on one, but let's say you legged in. I typically have had 4 on at a time on MES or whatever, and then I just recently had 3 on ES. But I would do them at different times, right? So automation would run, and let's say it's a week later or a couple weeks later, it's putting another one on, and the market's already moved. Now we're that much farther down, and we're selling that much farther down, right? Because we're sticking with those kind of same deltas. And when volatility is high, we should be getting more safety from that. And that should happen on any asset class, but for sure on the S&P. So I would say, I think adjustments need to be made from earnings perspective. I think a lot of this is probably the Mag 7, getting adjusted. I think it's probably going to continue, but it doesn't really matter the view. I think being consistent and just trading these statistically with automation is the benefit. Obviously, that's why we did it. I originally created it for myself, just because I couldn't trade during the day, during work, and I knew that I just wanted to be able to put them on, manage them how I wanted. So that's one thing. VIX obviously spiked. Now it's come back. So my opinion is that VIX is coming back down. It might come down a little more. If that's happening, I think S&P is rallying a little bit more, and it might rally back into that resistance level. At that same time, my guess is some of my positions will be hitting their profit targets and will come off. But that's just the way that I'm viewing things, playing it, and just letting things run, and ultimately should work over time. And hopefully we'll ultimately be seeing the P&L grow and the account grow. 12% up versus the market is, of course my battery's running low, versus the market is down. That's the way to play it. But I do think this feels a little more like a 2022 scenario, so definitely be cautious. But I think that actually is a big opportunity, because a lot of these strategies, like the one-on-ones, can work in slower downdrafts, and you can make more money. So I hope you guys enjoyed that. Hopefully it's a little bit shorter than normal. So that's the update, and appreciate you watching, and stay tuned for more.